Hello, good afternoon. This is Louis Llanes with Market Coffee Talk. I want to talk a little bit about some of the common questions we're getting about why is the market going higher. I was actually having a conversation with my wife, Jane, and she was telling me about how, a lot of people have been calling in and asking about why, wondering why is this market going up? And it's been going on for a while. Before the election happened, we had a lot of people concerned that the market was going to roll over, because of a lot of unrest that was going on and not sure about what a new administration would mean. And the market kept going higher. Now, at that time, we were saying, we expect stimulus to continue and we're likely to see a bull market right through the first quarter. And we did see that all the way through the first quarter ending March 31st. And we were expecting at that time about $1 trillion of stimulus. Well, it turns out that we got much more than what we were anticipating coming to the table in terms of stimulus. So that was a little bit of a surprise to the market. So I think that's one of the reasons why we're seeing the markets continuing to go up because of the stimulus. That combined with the fact that we have, the COVID numbers are coming down, people are getting vaccinated at a faster rate. So far, the data shows that people are not getting tremendously ill from the vaccinations. And also we're seeing, more travel open up and you're seeing earnings starting to improve. So I think that's one of the things that is throwing people off because there's been a lot of reasons why many people are thinking the market should go down, because of valuations and because of, just the unrest that we see. So I wanted to kind of talk a little bit about what we're seeing, why the market is continuing to go higher. Again, I think we had a big disconnect between what we were expecting in stimulus versus what we're actually getting. We're getting a lot more, like 3 times more than I think what Wall Street was anticipating, certainly what we were anticipating. And that's actually changing the dynamic of how investors should be investing. So one of the things that we've noticed is a lot of people are investing in last year's winners, and they're not really putting money in the way that they should be, or well, the way we believe you should be investing money for what's happening in the future. And so I want to talk a little bit about what we're seeing right now and what that means for investors, because I think if you take those names that everybody has been talking about from last year, you'll find that most of the new names don't make any sense from the standpoint of what's happening in the future, at least from our point of view. So I'm going to share my screen a little bit here and talk about some of these names. What I'd do is I'd go through a single stock in every sector that is more representative of what we're seeing as being the future for investment rather than something that was from the past. So I'm going to share this screen real quick. Sorry for the delay here. I'm going to go to a Chrome tab here. There we go. All right, you should see now a screen. And let's start off with the stock that I have up right now. This stock right here is Sprouts Farmers Market. So let me tell you what the common theme of what we're seeing of companies that look like the right companies to be in. The first would be the revenue growth is actually solid and strong despite what's happening in the economy, or their revenue is actually increasing because of an opening up of the economy. That's the first thing. The second thing is that their valuations are still attractive. Many stocks have taken big runs and their valuations are not attractive. So we're seeing money flowing out of those last year's winners into the new winners. And I think that's what we're really focusing in on. It's the revenue combination with valuation. And then also their quality. They have a strong balance sheet. So Sprouts Market is a prime example. They have a strong fundamental backdrop. They're a specialty grocer, and they have more healing-oriented assortment, fresh foods, natural delivery, and that trend is still doing well. So I think that's a good place to be. And also take a look at the chart. These stocks have not had huge runs. They're just now starting to break out from their long-term bases. So that's one example of a stock in the consumer defensive area. Take a look at, for example, in the basic materials area that people are not really thinking about right now. People have kind of been avoiding, but Here's a company that's in the special chemicals area. They're doing very, very well. They have a good value, a strong fundamental balance sheet, and the stock is starting to break out into new highs. They're in the a petrochemical producer in the U.S. and in Europe, and they operate six different segments. And so this is one where most people are not thinking about these names, but they potentially could do better in the basic materials in the communications area. Let's pull up a stock here for you. This is Nexstar Media. Notice Nexstar Media has hit a high, come down, starting to move up. Their value is very strong. Their fundamentals are very strong. The company is likely to do well in the future. They're one of the largest television station owner operators in the United States. So, and they're doing well. They have 4 broadcasters. Whether you like their politics or not, they got CBS, Fox, NBC, ABC. So this is one that you really should look at. I mean, at least we're looking at. I'm not. By the way, all these stocks that I'm talking about, they're not recommendations for any particular person. And full disclosure, I own these stocks, so keep that in mind. They may or may not be appropriate for you, but I'm trying to really communicate and convey the types of companies to be looking at rather than the companies from the past. If you go into the financial area, the financials have been unloved for a long time, and now they're coming into their own. There's many fundamental reasons why they look good, but here, take a look at Zions Bancorp. This is a company, again, strong valuation, strong fundamentals. It's a regional U.S. bank. They have core operations that are in 11 different states. They're like in Salt Lake. This is the kind of company that a lot of people are ignoring, but has a tremendous potential to go much higher. If we go to the healthcare sector, and I really wanted to go into each sector just to show that this is really throughout the economy. It's not necessarily in one particular sector. You have United Therapeutics. United Therapeutics, they are a drug development company in the pulmonary arterial hypertension. And so they're dealing with a rare disease, but they have a niche, a strong niche, strong valuation, strong fundamentals. Another one to look at. Most people are not even thinking about a company like this. Another one in the industrials. There are a tremendous amount of stocks that are hitting our criteria in the industrial areas. One of the things that you're going to find is that the mid cap and the small cap companies are more attractive relative compared to the large cap companies. There's everybody boatloaded into the large caps with index funds and with money managers that buy a lot of the big caps. And those stocks are overvalued relative to the mid-size and the small cap companies that have better growth, less susceptible to various geopolitical risks that we see, in particular with China. So I really like. We're just finding from a bottom-up perspective that more stocks are attractive in the mid cap and the small cap area. Here's an example. It's a rental truck company for moving. A lot of people are moving. And that trend is likely to continue. The stock is still strong balance sheet wise, still reasonably priced in terms of their valuation. There's many examples I could go through in the industrial area, but even in real estate, a lot of people have been shying away from real estate because a lot of companies are not full. They're not in the big buildings anymore. But what we're seeing is they're starting to go back to them, and the market hasn't fully valued the companies, in our opinion, based on what is happening right now. So you have a company like Kimco Realty, very strong value, very strong fundamentals, and strong balance sheet. And they're one of the oldest real estate investment trusts in the U.S., where they own interest in 399 shopping centers, right? So the shopping center area is different. Now we can go into other areas. There are companies that I won't mention, but there are some companies that are in other parts of real estate that also could be attractive as well. And of course, everybody loves technology, and in technology, there's a lot of different things to choose from. Right now, the chips, Lam Research is one of the companies that we really like. Lam Research has still got a strong fundamental score. Their valuation is still reasonable, off a little bit from the highs, showing it's a semiconductor equipment and material company. They manufacture equipment used to fabricate semiconductors. And for many different reasons, this particular company is doing very well. So that's another example. And even in the utility areas, you can find some companies. And you notice a lot of these are smaller companies that you're really not hearing about. Company UGI Corp. UGI is an American holding company. They're involved in transport and marketing of energy and related services. So that in that energy area, yeah. And again, there's companies in the energy itself, right? I've been talking about energy for a while. We've had a nice run up, but take a look at Valvoline. Valvoline is an oil and gas refining and marketing company. Good valuation, strong cash flows. This is a particular type of company that we like. So I guess the moral of the story here is that last year's winners are not necessarily going to be this year's winners. And a lot of people may not be positioned correctly, what we think correctly, for what's happening now. And the other part of this is that there's lots of reasons why the market is going to go up, and that we think that it will continue to go up. Of course, we don't have a crystal ball. We don't know for sure. But our rationale is that the market is likely to go higher because, first of all, there's a ton of money sloshing around the system due to the stimulus and lower interest rates. Because of those lower interest rates, there's nowhere to go. So money is going into real estate. Money is going into stocks. I mean, in the real estate market, there's a bunch of packaging, private money that's being packaged. In fintech, there's private money. So there's a lot of money trying to find a home. And that is likely to continue to drive stock prices higher. Now, some people could say it could be bubble-like. I think that in times like now, when there's a lot of disbelief, investors should try to capitalize on this as much as possible and use strong risk management to take advantage of that. So if you would like, if you want to have a review of your portfolio to see if your portfolio is aligned to what we're seeing happening in the marketplace, just let us know. You can go to our websites, scrolling on the bottom here, wealthnetinvest.com. Let us know. We'll be glad to give you a second opinion. I hope you're doing well, and we will talk to you later.